Welcome to peak earnings week. It is just 30 minutes until the start of cash equity trade. I'm Dani Burger. Matt Miller still out. Bloomberg Open Interest starts right now. Coming up, Nvidia revised fear of circular AI deals ahead of the biggest week for this earnings season. Fed officials head into a potentially contentious policy meeting as price pressures rebound. Meanwhile, geopolitical tensions ease for now. Oil drops as the U.S. and Iran hit pause on further strikes. All right, so we have quite a lot to watch today. So some of the stocks that we are looking out for, big tech is going to be earning. Tech alone, Apple, Amazon, Microsoft, and Meta are 17% of the S&P 500. $24 trillion worth of companies will be reporting in total this week. The index is also coming off of its first 2-week loss since March, so maybe that's a good thing. Maybe expectations are a little bit lower heading into these earnings as they had been. At the same time, Nvidia working on a fresh round of AI infrastructure deals, potentially worth more than $750 billion, including $500 billion initiative with SK Hynix and a $250 billion data center project with OpenAI. Nvidia CEO Jensen Huang spoke exclusively with Bloomberg Tech's Ed Ludlow on the future of computing.
We used to build computers for people to use, and we're going to still continue to build incredible computers. These are now processing AIs for humans to collaborate with. But in the future, we also have AI agents and robots, and they're going to be using computers. So instead of just 1 billion people using computers, we're going to have 100 billion agents and billions of robots all using computers. The computer industry, the chip that's built on top of the chip industry, surely is not big enough.
Ed Ludlow joins us now. Ed, excellent conversation. It's clear that Jensen has some large ambitions, and from this morning's news, they're not slowing down on spending to get themselves there.
Yeah, I mean, the status quo remains that demand vastly outpaces his industry's ability to supply. What Bloomberg's reporting is that Nvidia is on the hook for about $750 billion of, let's call it, financing support. So the one from Friday was SK Hynix, $500 billion. But that's kind of an aggregated number where the $500 billion or $500 billion represents Nvidia's commitment to buy memory chips from SK. It represents SK's commitment to buy computing systems from Nvidia. And it represents a shared ambition to kind of build infrastructure in the region. OpenAI, what we're reporting is that Nvidia is saying they will backstop, they will guarantee $250 billion of leases for the data center in Ohio. This is all according to sources. None of the companies involved have commented on it. And so you're right, $750 billion in total, but it doesn't even take into account the sort of part B of that story, which is Nvidia financing OpenAI's purchase of Nvidia chips of $350 billion. And that's where the concern on circular financing probably is more concentrated.
And for what it's worth, we have another Nvidia investment just crossing the wire, Ed, making an investment in Safe Superintelligence, provide access to its Vera Rubin compute platform. So again, the spending does continue. Part of this, Ed, I just wonder, is getting around bottlenecks. How much of this, for example, is about OpenAI no longer having to rely on Microsoft, Amazon, and Oracle as they ramp up their own spending?
The Safe Superintelligence thing is really interesting.
Yeah, tell us more about that. I know it's going to be just your first take.
So we don't know much about that startup. It's founded by Ilya Sutskever, part of the OpenAI alumni network. They're working on something to do with AI and finance and financial markets. But I'm going to look into it more. To answer your question, Nvidia's argument to this point on circular financing is the reason it's not circular financing is there's no quid pro quo. Nvidia is trying to grease the wheels, support the ecosystem, allow people to move more quickly to build the actual infrastructure, but they're not contractually required to buy Nvidia gear. So if Nvidia supports OpenAI, as an example, Nvidia would say, okay, but you can also go and do business with AMD. Part of it as well is just like communication. So, we just explained the $750 billion headline from the circular financing story on the terminal. Nvidia just came out and were like, we're going to do $500 billion with SK. But they didn't really say anything more than that. What does that even mean? Like, who's giving money to who? It's not really explained beyond what I did in that interview, which was like, it represents all of it. Nvidia's hand into the pot, SK's contribution, and then things that they share. And there's a lot of confusion about that. People just want more detail.
Interesting, Ed. Looking forward to hearing more and hopefully hearing more detail on Bloomberg Tech. That airs at 11 a.m. Ed Ludlow, thank you so much, host of Bloomberg Tech. The other big market-moving event this week, as if tech spending and earnings weren't enough for you, we also have the Fed. And markets are currently pricing in a 30% chance of an interest rate hike on Wednesday as renewed tensions in the Middle East send oil prices soaring again, overshadowed by a tamer-than-expected inflation prints for June. And we'll also get PCE this week, too. Bloomberg International Economics and Policy correspondent Michael McKee joins us live from Washington. Mike, I have seen some conspiracy theories swirling around that perhaps this administration has pulled back the reins on striking on Iran to give the Fed more breathing room and hope that they weren't hike. But how are we set up for the meeting this week?
Well, you know, I heard that rumor this morning as well. Somebody asked me about it. I don't think there's any truth to that. It would be quite an effort to do something like that and to bet that the markets would go down, the oil markets would go down. They have, but that's still the open question as they go into the meeting, because at some point, something's got to be resolved, and until it is, there's a lot of uncertainty, which makes the main question what happens with inflation going forward, as most of the members of the Fed have been telling us. You've got a tame CPI and tame PPI in the first month of the summer in June, and PCE, as you mentioned, comes out the day after the Fed. Do they want to raise rates and then have a lower inflation number the day after? That's an interesting question. The economy's slowing a little bit. Atlanta Fed says 1.7% for the current quarter so far. But financial conditions are still very easy, and we see that in all of the markets. Underlying inflation, slower growth, those are questions going forward, because even if you take out energy prices, inflation is still well above target. And then finally, there's uncertainty about this Warsh Fed. What are they going to do, and how are they going to do it, and what are they going to tell us about it? So that leaves open the possibility that we might see a rate increase. Probably not, but you know, the two-year note yield has priced in a rate increase. Why that is? Well, it's not inflation, because you can see the break-even there is gone down in recent weeks, while the odds of a rate increase in the two-year space have gone up. A lot of people who follow this say it's probably because the budget's coming up and they're worried about what Treasury is going to have to offer to sell bonds under these circumstances. But still, the Fed does have that room to raise because the 2 years already priced it in. We do have also data coming up that would enable them to wait if they want until September. You get 2 CPIs, 2 PPIs. You also get 2 PCE reports, and you get 2 payroll reports before the next time the Fed meets. So there's a lot of information, a lot of reasons why they could hold off. But then what does Kevin Warsh say about it all in his press conference? That's going to be the real question at this point.
And what does he not say? I mean, what a better way to kind of say, I'm not giving you forward guidance than hiking this meeting and not telling you much about why or what happens next. Mike, we do get PCE, as you mentioned. This is the one that we know a lot of the inputs into it, so less of a surprise. So what are we expecting for the data itself?
Well, we're expecting both headline and core to tick down by a percentage point. In terms of the headline for a month over month, is expected to be negative, 1/10 of a point lower, which will push down the year over year numbers for headline and core significantly. But they're still way above the Fed's target. And that's going to be the argument for them is, do they look forward and say, we're not going to make more progress than this because we've already taken out energy? Or do they say, we're on the right road? That's the decision they're going to have to make, and it's probably going to be a very tight one, Dani. You know, even if they hold, there's expected to be a couple of dissents at least.
It's a fair point, and Mike, really looking forward to your coverage. Bloomberg's Michael McKee in Washington, D.C., ahead of the Fed decision. Let's turn down to one of the biggest impacts on that Fed decision, and that's what's happening in the Middle East. Brent falling below $91 a barrel after the U.S. and Iran held off on further attacks for a third straight night. Let's get the latest from Bloomberg Washington correspondent Tyler Kendall. Tyler, various reporting out there as to why attacks have been held off, from hopes from diplomacy to Washington's own weapons stockpile. What are we hearing at this moment?
Well, Dani, at this point, it feels like there is room being created for diplomacy, though the White House hasn't taken the threat of escalation off the table quite yet. We're getting a few different indications on what the U.S. right now is assessing as it tries to figure out exactly what the next step is going to be. We had this reporting from Axios over the weekend, for example, showing that the top commander in the Middle East, Admiral Brad Cooper, advised against further strikes, saying that they had reached their limit of effectiveness. And then this other reporting from the New York Times, which seemed to signal that the U.S. could be concerned about diminishing stockpiles. Our own analyst at Bloomberg Economics estimates that it takes between $30 and $45 million per day to just keep up the U.S. naval blockade, as one example, though this White House has maintained that they feel confident in their amount of stockpiles. And we heard from the U.S. ambassador to the UN, Mike Waltz, in an interview over the weekend saying that President Trump still retains all options, though he did allude to the fact that it seems that talks are happening, he says, at both the more nuanced technical level as well as the leadership level. The issue is, at this point, even as the fighting has stalled, we're still seeing those disruptions in the Strait of Hormuz. New data out today from research from Kepler shows that over the weekend, on average, we saw between 6 and 12 vessels transit, but that's actually in line and matches the amount that was moving through when the U.S. was in its consecutive day of strikes. And Dani, new this morning, Iranian state media saying that the IRGC forced at least 6 ships that were going through that U.S. coordinated route along the coast of Oman to turn around, just keeping that heightened fear among ship owners as the conflict still continues.
Tyler, thank you so much for that update. That's Bloomberg's Tyler Kendall in Washington. Let's get a check on your equity markets 20 minutes before your opening bell on a week that is monumental between a Fed decision and the busiest week for earnings. We are rebounding after 2 back-to-back losses for this S&P, the first since March. NASDAQ outperforms after the Mag 7 dragged down the overall indexes last week. Yields also come down 3 basis points, with energy moving lower. Brent crude trading just below $91 a barrel. Let's also look at some of the single-name movers on your radar this morning. With that is Bloomberg's Nora Melinda. Nora.
Hey, Dani. Jack Daniel's owner Brown-Forman rejected a $15 billion takeover offer from Sazerac, with the board saying a merger would not align with their vision for the company. It would have been a 23% premium to Brown-Forman's valuation as of Friday's close. And up next, Ford gets an upgrade to buy at Jefferies ahead of earnings tomorrow afternoon. Analysts say management could raise guidance with market conditions healthy and the second quarter potentially a low point for sales volume. And finally, D-Wave Quantum expanded its computing deal with AT&T as the wireless carrier touts progress with its agentic AI tools. Details of the contract were not disclosed. Dani?
Nora, thank you very much. Nora Melinda with your morning movers. Coming up, investors now have another way to bet on the world's biggest stocks without trading a single share or using complicated options. We're going to have more on CME single stock futures next. You're watching Bloomberg Open Interest. Let's get you some high-interest stories. A look at what's making headlines around the world. Chipmaker CXMT surged 466% in its Shanghai trading debut, becoming China's largest onshore-listed company, now valued at $488 billion. The company posted the second biggest IPO in the country's history as Beijing ramps up its push to secure AI independence. Elsewhere in the world of AI, SoftBank's $40 billion bridge loan for its investment in OpenAI has attracted a new group of 21 lenders. Sources telling us that the new lenders have been allocated around $7 billion of the facility. Standard Chartered, First Abu Dhabi Bank, and Singapore's Sovereign Wealth Fund, GIC, have each taken a $1 billion share. And the CME is set to launch single stock futures today. This will allow investors to hedge or speculate on more than 50 of the largest U.S. companies. The contracts will be cash settled on the closing price of the stocks that they are tied to, and trading will be open 23 hours a day, 5 days a week. Let's discuss this story and more with Bloomberg finance reporter Catherine Doherty. Cato, the casino is open, it would seem.
Yes, this is another tool in the toolbox. They are going after retail investors, which is kind of moving away from CME's core audience. Think of institutional investors these large firms that are trading in size. These are contracts that are going to be specifically tailored to the smaller audience, or I would say the smaller individual trader. And because it is targeted at this audience, this is giving CME yet another avenue to widen its own business into other areas, other arenas. But specifically for single stock futures, it's going to give institutional as well exposure to some of these hot stocks without actually owning the stocks themselves. It's allowing just another hedging tool in the toolbox. So it's another really big launch for the company. It seems like every week they're announcing another product.
And that would be about getting exposure to certain companies that they don't own, would seem especially useful. And you and the team write about this in the story for something like SpaceX, where you maybe didn't even get the allocation you wanted.
Yes. So for retail investors that wanted to buy SpaceX stocks and weren't able to, they can now get exposure to a name like SpaceX. They're starting with 50 names, and it's the biggest, largest, most liquid names in the U.S. stock market. And that will give, again, it's a cost. This is a cash settled product. So instead of owning the shares directly, you are still getting exposure and you're tracking the future price. And when it settles, you are getting that cash, but you're not actually changing stocks at any point. You're not owning the underlying stock.
You don't need to worry about Greeks and Vega and Delta and Gamma and all those things. Catherine, the other story that you're reporting on this morning is Fanatics buying one of the brokerages, BGC. I think of Fanatics about selling jerseys, about different fan gear. This is about prediction markets. To what degree are they getting more into prediction markets than they are currently?
So Fanatics has been moving away, but keeping the core of, we have an audience of consumers, sports-related consumers specifically. And today's announcement is that they are buying a license from BGC to operate their own prediction market exchange. So because of that, they will be able to list prediction market contracts, yes or no. They're going to start with sports, so staying with their core audience, and expand eventually to other yes or no instances. It could be markets related. But right now, the deal today that they are announcing is that they're going to be operating their own venue. That gives them, again, more control. Right now, they do have prediction markets, but they work with Crypto.com. They use Crypto.com's exchange. So now that they have their own, that gives them a little bit more flexibility. It keeps all of their consumers in the same place. And for BGC, this is a partnership. So BGC is looking to bring some of the institutional interest in prediction markets and help with some of the pricing that goes on. So these firms are both acknowledging that with prediction markets, you need both retail and institutional interest for this market to grow. Right now, it's very much concentrated with retail participation. So with pricing, you need the institutional players to come in and help grow that market.
That's really interesting. I hadn't thought about that before, because presumably FanDuel, DraftKings are all retail. Because I was going to ask, how do you compete with them? They're already well-established names. Is the idea not to compete, that they have a different product because they are bringing in institutions?
This is a very competitive space. And when you think about Polymarket, Kalshi, coming out of the largest games that we have seen with the NBA Finals, coming out of the World Cup, sports is still dominating prediction markets. And so when you have Fanatics, FanDuel, other companies that tailor to the sports market, they are now trying to differentiate themselves. You need to find what is the edge, because if you are appealing to the retail audience, these consumers, you want to give them the incentive to come to your site, to come to your application. So Fanatics is betting that by adding their own new venue that they can, again, tailor to their audience, and then bringing on a new marketplace, this institutional marketplace, that's where BGC comes in, and they're trying to gain that edge by bringing something a little new, a new flavor to the prediction
Really
markets.
interesting. Catherine, thank you so much for bringing us those stories. That's Bloomberg's Catherine Doherty. Coming up on the show, Citi Wealth's Kate Moore says she favors equities despite stretched valuations. She joins us next. This is Bloomberg Open Interest. Citi Wealth leaning into equities as companies report healthy earnings growth. Chief Investment Officer Kate Moore says, in terms of our core portfolio positioning, we continue to favor a full allocation to equities with an overweight to U.S. large caps where fundamentals are most attractive. Let's bring Kate Moore in, Citi Wealth Chief Investment Officer. Kate, great to see you. I wonder how much of this investment, still going full out on equities, is just about that valuations still look attractive with us trading under a 24 times PE yet again, versus perhaps even if we weren't there and we hadn't sold off over the past 2 weeks, you would still be this bullish on equities.
Yeah, look, the thing that I love about equities so far in 2026 is that it's been earnings, not price, that has really kind of driven things. Like, look, everyone was concerned at the beginning of this year around multiples and around valuation. And this has been a recurrent concern. We continue to wring our hands as multiples have ground higher over the course of a number of years. But this year, because it's earnings and not multiples that are driving markets higher, and because the fundamentals continue to come in very strong, and we expect actually very solid reporting over the course of this week, that we feel more comfortable in continuing to add to positions, especially when there are bits of a pullback. I would note, though, of course, we've been in this trading range for the last couple months, and it's going to take a broader, array of investors to get comfortable with adding additional risk to really drive the markets up higher into year end. But we think that can happen as some of the worries that people have around geopolitics, inflation, rates, and AI sustainability fade.
All right, Kate, stick with us because we got to get through the opening bell first. Kate Moore, she's staying around as we head into your opening bell. Again, that's going to come in just under 5 minutes' time. Here's how your markets are shaping up ahead of that. A monumental week for both earnings and a Fed decision that's considered live. We are pricing in a third of a chance that we will get a hike. At the moment, NASDAQ outperforms after underperforming for much of the past 2 weeks. It's up 1 1/5% as the S&P goes up by 0.8%. Yields come in. That gives us some breathing room, not least for the Fed as well. And Brent crude just below $91 a barrel. Up next, it's your opening bell. You're watching Open Interest. Let's get your trading started. Moments away from your cash open trade. This is Bloomberg Open Interest. I'm Dani Burger, and it is a rebound to start your week after 2 consecutive weeks of declines, the first time since March. It's being led by tech this morning after tech led us downwards for most of the past 2 weeks, up more than 1%. Heading in to your opening bell as the S&P is up 0.8%. We've had a lot of charities ringing the New York Stock Exchange as of late. Today, it's the Catholic Charities of New York. We have the Most Reverend ringing the bell. Someone who's Catholic needs to message me and explain to me how titles work, because the Most Reverend is basically the coolest title I have ever heard. I want to know how I become the most anchor. Down at the NASDAQ, we have D-Wave. Kind of a coup for the NASDAQ. They were trading on the New York Stock Exchange. They've went over to the NASDAQ, so they're ringing the opening bell. They're down 14% year to date, but a great day for D-Wave. They're up 10%, or at least they were pre-market. I haven't checked since the market opened. Signing an agreement with AT&T. They do quantum computing, and they're giving AT&T expanded access for that. In terms of what's moving this morning, we are watching all of the big Mag 7 names that are going to be reporting their earnings this week. Apple, Amazon, Microsoft, and Meta. They are among the $24 trillion worth of S&P 500 companies that are going to be reporting this week. So that's the busiest of the earnings season. The index, though, is coming off that first back-to-back loss since March. At the same time, Nvidia working on a fresh round of AI infrastructure deals, potentially worth more than $750 billion. That includes a $500 billion initiative with SK Hynix and a $250 billion data center with OpenAI. Nvidia fluctuating between gains and losses as concerns of circular finance are thrust back into the fore. Let's bring in Citi Wealth Chief Investment Officer Kate Moore, who's still with us. Kate, I wonder how you're thinking about hyperscaler spending, Nvidia spending, the circularity of it, and how this market is likely to continue to receive those numbers as we go through the rest of the earnings this week.
Look, I mean, amongst all the worries that we've had, again, over the course of 26, and this was sort of echo of the second half of 2025 as well, is this worry around, are companies spending too much? And if they're spending too much, how do we think about the return on investment? I mean, this is a consistent investor angst. What I will say, and we're going to get a lot of information about this over the course of the week, is we actually see no signs of any slowdown in overall Capex. We got that from Alphabet last week, and a very clear message that the increase in spend is because of demand, and that they're going to likely revise up their 2027 expectations for Capex and spending. But something I just want to highlight here, we focus a lot around the Capex in the AI and tech space, but actually overall investment in the economy is exceptionally strong. In fact, we got data this morning suggesting that momentum is very, very strong. So when we think about the investment cycle, it's not just AI and tech, but also the broadening out of the spending that's happening and how that's going to support both the macro and we think a widening array of fundamentals across industries.
So to what degree, though, is it outside of tech, Kate? Because the point has been made by Torsten Slok and others that it's an economy increasingly reliant on AI spend. Does the kind of figures you're seeing for this macroeconomy give you confidence that should we see a pullback on spending by some of these tech players, that this is an economy that will do okay and not slip into a recession?
Yeah, I'm not worried about the economy slipping into recession, but if we were to get either a pause, I don't think we're going to get a cut, but a pause in terms of overall Capex spending, I do think that would be another shock to sentiment. We monitor sentiment, very closely, as well as positioning. That's a big part of our process. And, our readings now suggest that actually sentiment has slipped further over the last 2 weeks. So we're in kind of this summer doldrums, again, cycling through these worries around AI Capex, geopolitics, inflation, et cetera. And I think, if we were to get any of these sort of shocks, whether it's around a broadening of the war or further challenges to energy supply, or the AI tech and Capex spending backing off, I think we'd see another hit to sentiment. But I don't think it derails the economy. I mean, that's the important thing. In fact, one of the things we were talking about earlier this morning is how strong the economic surprises have been, not just in the back end of 2025, but throughout the course of 2026. You can say economists maybe have been conservative, but you can also say that the data has come in much stronger across almost every metric, on consumer side, on business side, and that activity we expect to continue into the back half of this year. So a very strong macro backdrop, but sentiment could take a hit further if there was any sort of talk around pausing or stabilization in terms of the Capex landscape for AI.
Can we talk about that macro backdrop, Kate, especially as it relates to this week? This is a market that considers the meeting live from this new Fed chair, Kevin Warsh. What are your expectations, and could Fed hikes change some of your outlook?
Yeah, so our expectation is not that we're going to get a hike this week. Of course, it's not a zero probability event, and we see that, of course, getting priced into markets. A key message we've had over the course of this year has effectively been that inflation has been broad enough and persistent enough that even before the shocks from the Iran war, that the Fed was going to have to really consider more of a tightening bias rather than easing bias. And the market caught up and then sort of overshot on that front. And we think the most likely next move from the Fed is a hike, although the timing of that, again, doesn't seem likely this week. I think the important point here is when you strip out the energy effects, there is sort of broad-based goods inflation. And we are now overshooting the Fed's target for over kind of 5.5 years. And I think Chair Warsh made this very clear in the June commentary and during the presser that they were very focused on that 2% target. And so I think it's unlikely that we would get any type of easing, but the tightening starting as soon as this week is not a high probability event in my mind.
Well, perhaps what Kevin Warsh needs to do is bring the long end down. He's concerned about the housing market and about financing. And this is a long end that has been drifting higher. Kate, for the 30-year yield, we are above 5.1%. Real yields are also incredibly high. Just for the price of a 30-year yield, it's been above 5% for the longest streak since 2008. Should that be impacting, or has it even been impacting risk assets at this point?
We've seen the relationship between bonds and equities actually break down considerably. And it's one of the reasons why we've shifted a little bit of our portfolio construction to look for diversifiers. Because, our expectation is that yields, particularly the long end, will stay elevated. I don't know that we get the 10-year creeping up to 5%. I think that's a psychologically important level, and people would likely be buyers at that point. But that the long end will remain elevated. And against that backdrop, we've also seen bonds not perform the way that we would historically want them to perform in periods of shock, right? We've had equities down and yields up in a couple of these shock moments, which also leads us to believe that we need to, really rethink our portfolio construction. One thing I would also note is we've heard a lot of officials and pundits discuss, the impact that these higher long end yields are having on government funding. We know the deficits are going up in the U.S. and around the rest of the world, and that's something that governments are really going to have to grapple with. To the extent that the Fed and politicians discuss wanting to keep the long end anchored, they can try and jawbone it, but if the market is concerned around overall spending and the persistence of inflation, I think it's going to be really hard for them to do. So we've remained very short duration in terms of our portfolio, and I see very little reason to add duration in the near term.
Kate, the difference in correlation between fixed income, government bonds, and equities, can we extend this conversation to corporate bonds? Because later we're going to be talking to Carlyle's Akhil Bansal, who oversees asset-backed financing, and is basically making the pitch that traditional fixed income corporate bonds don't give you diversification anymore. A 60-40 portfolio doesn't work because of all the tech issuance and just how highly correlated equities are now to credit. Are you seeing the same concern? Have you rethought at all about the place for traditional fixed income, specifically corporate credit, in a portfolio now?
Yeah, we prefer to take our risk in equities over credit at this point. But of course, that doesn't mean we have got rid of all of our credit exposure. The one thing I would flag here, and this is an important one, is I was making this point around valuations compressing over the course of 2026 as earnings have outpriced the price movement. But that has not happened in the credit space. Spreads are still incredibly tight. They're trading close to their 15-year tights. And there's been a little bit of a disconnect between the equity and corporate credit environment. So here's what I would say. You have to be very thoughtful, too, about where you allocate in credit, because spreads remain really tight and don't reflect the same types of concerns that equities have reflected. And that you're right, there continues to be some more overlap in terms of the sector exposure and the thematic exposure that you may be getting in credit. We're not at a point right now where we would say this is concerning. In fact, we think some of the companies that are issuing corporate credit are actually very high quality, and it can be an interesting part of your overall credit portfolio. But it's something that bears watching. And as the tech and AI related credit becomes a larger percentage of the overall market, we will have to ask ourselves, how much overlap are we comfortable having between our credit and our equity exposure, but still biased towards equities over credit at this point.
Kate, always insightful. Wonderful to start the week with you. That's Citi's Kate Moore. Enjoy the rest of your week. Let's get a check on your equity markets about 10 minutes into your trading day, and we are pushing higher ahead of a very busy week, up 0.8%. That's 62 points, with the majority of stocks moving higher, so the breath is good today. The Mag 7, those companies that are reporting earnings coming up this week on Wednesday and Thursday, they're the ones doing the majority of the lifting for this equity index. Microsoft, Alphabet, Apple, Amazon, all of them moving higher alongside Meta. Also a good day for the banks. JP Morgan, Goldman are also in your top winners column. To the downside, again, it's this two sides of the same coin that keeps happening. On days where the hyperscalers are up, it feels like it's always the chip makers that are down. Lam Research, Applied Material, also a story coming out that China, they have a company that makes the equipment to make chips, is looking at selling it quite cheaply. So that's also hurting some of the lithography makers in Europe. Maybe that's also coming to today's session. Gas and oil players also down as the price of oil falls, rather. So if you look at the various sectors, you will see that energy is faring the worst today, with Brent crude below $91 a barrel. There you go, down 1.2%. Communications does well because some of the Mag 7 names in there. Discretionary financials also having a good day, again rebounding after a back-to-back loss for this S&P 500. Coming up, we're going to dive deeper into tech, where AI spending is going to be the focus in the earnings we get this week. We look ahead. This is Bloomberg. Let's get you some top calls now. Here's Nora Melinda with some of the analyst action we're watching this morning. Nora.
Hey, Dani. First up, Jefferies upgrading forward to buy, expecting the company to potentially raise its outlook when it reports second quarter earnings tomorrow. And next up, Piper Sandler downgrading Stellantis to underweight, saying it favors companies that are building next-generation machines using in-house expertise. And finally, Philips Securities upgrading Alphabet to buy, pointing to the company's results last week that underscored AI strength. Those are your top calls. Dani,
Nora, thank you very much. Let's stick with tech, and AI spending remains in focus this week as we get more big tech earnings. Nvidia CEO Jensen Huang spoke exclusively to Bloomberg about how the U.S. and China are approaching the AI race.
In the case of China, they're producing more AI researchers than probably all of the world has, in any given year. And so they're producing, if manufacturing intelligence is important, they manufacture the most important version of it, which is the researchers. And so this is an area, a country that's going to produce excellent AI technology.
Joining me now is Bloomberg Intelligence Head of Global Technology, Mandeep Singh. Mandeep, great to see you. So $750 billion of deals Nvidia is inking. It's a lot, and it's into their customers like OpenAI and others, and we revived this fear of circular financing that's been floating out there in some shape or form for the past couple of years. How are you viewing this?
I mean, look, the numbers are getting very big for Nvidia as well as for these model companies, Anthropic and OpenAI. When you look at the kind of spend they want to make, like there's no way they have the balance sheet like the hyperscalers to do it all themselves. So, vendors lease support, which is what Nvidia seems to be doing for OpenAI, is just one way for Nvidia to make sure that they have an ecosystem. Even though all these companies are developing their own chips, I mean, whether it's the hyperscalers, even OpenAI, now it's developing its own chip. But Nvidia wants to make sure that the build-out continues at this pace without a digestion period, because that's a big risk for Nvidia is if things take a pause, even if it's for 6 months, that's not going to go very well for them.
So one of the bottlenecks continues to be memory, and in China we've had CXMT list, a Chinese memory chip maker, surging something like 500% after it IPOs, a huge amount. I mean, that's certainly not being priced like memory is still cyclical, but how difficult is it for a new entrant to come in and shake things up and actually gain market share, especially if they're a Chinese company?
I mean, in this case, it's really about Apple, because they are the ones who have shown the intent that they want to diversify away from, the memory oligopoly of these three companies. And Apple doesn't need HBM right now. They need DRAM and, the traditional conventional memory, which is prices have gone through the roof because, we are supply constrained. So if Apple is able to qualify CXMT, that's a huge deal, for the entire memory complex, because suddenly all the free cash flow that's generated by DRAM is things are gonna slow down, because the DRAM ASPs have been off the chart. So that's where Apple is the key player, and they're the ones who are looking to use CXMT in a big way.
And perhaps not surprising, the Wall Street Journal reporting over the weekend that Micron is pushing back on Apple's appeal to use chips from them. Just while we're on the subject of the China versus the AI race, Jensen Huang put out a letter that has some signatories on it of a lot of the big tech companies. He joined X for the first time, and he basically writes, my first post on X is about this appeal that we should have an open ecosystem. That's what he says. AI will transform every industry, power every company, and be built by every country. This idea that we need open models, that they strengthen the safety and cybersecurity. There's been a lot of discussion about this online. I would just love to hear what your take was on this.
I mean, the three key companies that are missing in this list are OpenAI, Anthropic, and Google. And so what's at stake, because everyone sees these three companies as the clear leaders when it comes to monetizing the models. And even a company like Nvidia feels threatened that if they continue with the ramp, Nvidia won't have the cloud that they have right now with the chips. So they want an open ecosystem and more fragmented model players, as opposed to power being concentrated with these three companies. So it's really right now a race between which complex is able to run away with this market, because it may very well turn out to be a duopoly or an oligopoly with the model companies if the open source is not at play here.
Right. Mandeep, thank you so much for joining. Always a joy to have you on. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, the owner of Jack Daniels rejects Sazerac again. That's coming up next. We discuss. This is Bloomberg Open Interest. Welcome back to Bloomberg Open Interest. We are 20 minutes into your trading day, and it's an equity index that pushes higher on solid breath. Although we are off the highs of the NASDAQ, we're up about 0.75% for both the S&P and the NASDAQ. As small caps outperform, that's in large part thanks to yields coming down nearly 3 basis points for your 10-year yield at 4.65. That's in turn being helped by Brent crude dropping 6% as a firing between both the U.S. and Iran seemed to cease, not cease fire, to be clear, but at least the attacks on one another seem to have halted over the weekend. Elsewhere, in some of the individual moves, Nvidia shares are lower by 2% as they can commit $750 billion worth of spending on various deals. Micron is higher. AT&T and D-Wave both pushing higher, much higher for D-Wave after they secure a deal with AT&T over providing computing, quantum computing. United Airlines also rallying off the back of oil prices coming in, and Brown-Forman up more than 1%. And the Jack Daniels maker, Brown-Forman, they have rejected a renewed $15 billion takeover offer from Sazerac, which was looking to add the iconic whiskey label to its portfolio, which already includes more than 500 brands. Here with more is Bloomberg's Red Brown. Red, why is Sazerac coming in? They've tried this before, and it didn't work. Why try to take another bite?
Yeah, I think the news that sort of kicked off with Brown-Forman earlier this year, Pernod obviously publicly announcing that they had talks with the company. I think if you're Sazerac, one of the few liquor companies in the world right now that is actually gaining ground, having sales success, if you see that, you know, kind of a crown jewel of the liquor industry, Jack Daniels, is potentially on the auction block, I think it's too good of an opportunity to turn down, which I think is also kind of underlying some of this conviction we see with multiple bids coming from Sazerac. They're clearly, they believe that they could bring value to this brand, revive this brand to some extent. So I think that's why we've seen their sort of continued persistence in making an offer. And
you could see maybe why they'd want to be sold. The price there over the past 5 years falling 64%. Is this company, though, up on the auction block if Brown-Forman and the controlling family continues to turn them away?
Yeah, I guess it depends on who's offering. It seems like, you know, we did some reporting earlier this year around the Pernod deal that, you know, they were, the family that controls Brown-Forman was in favor of that deal. So it seemed like there was good momentum. It seemed like there was this sense that there's going to be something there. But Sazerac coming in with an improved offer from what Pernod was even able to give. And it's been, you know, no discussions at all. It seems like, given some of the reporting we were doing yesterday, that there has not been any sort of substantive conversation between these two parties.
I would say this feels like your classic company where you'd have an activist investor come in. It's consumer, it's underperformed, a clear M&A strategy. And I just wonder how much breathing room there even is for either shareholder or activist influence, just given the family's influence. How large is it for Brown-Forman?
Yeah, I mean, the family has a very tight grip on this company. I was going to say that was probably the reason that activist investors probably have not stepped in quite yet, is because it's at least one controlling group for the family. It's called Wolf Pen. They control 60% of the voting shares, the Class A shares. So it really does not allow for someone to come in and make any sort of significant moves, right? Everything basically needs to have family rubber stamp to change. So yeah, it's very unclear kind of where they go from
By the
here.
way, why has Brown-Forman in recent years been underperforming? Is it just more competition for the whiskey market?
It's complicated. It's kind of death by 1,000 cuts. The industry overall is contracting, right? We hear a lot about sort of lower drinking consumption rates for some generations. There's the rise
you can say Gen Z. They're super uncool.
Yeah, don't want to name names, but that's a factor. There's a lot of talk about cannabis maybe stealing some market share from alcohol drinking on those occasions, things like that. But there's also a sense that there's particular problems with Brown-Forman, right? Like, they haven't made the best acquisitions in the past. Their portfolio is not very expansive. They're ready to drink, which is one of the categories that is growing really healthily. Right. Their portfolio is not very popular among people there. So there are certain things that Brown-Forman has done that is sort of also putting pressure on the stock. It's not just this industry story.
All right, Red, thank you so much for joining Bloomberg's Red Brown on the latest. And be sure to catch Bloomberg Deals every Wednesday, 12 p.m. New York time. Coming up, it's your Hour 2 of Open Interest. 30 minutes into your trading day. Welcome back to Bloomberg Open Interest. I'm Dani Burger. Matt Miller still off for paternity leave. It's a market that is rallying ahead of some big tech earnings. But first, coming up on the show, Nvidia revives fears of circular AI deals ahead of that, the biggest week of the earnings season. Elsewhere, Fed officials head into a potentially contentious policy meeting as prices pressures rebound. Meanwhile, geopolitical tensions ease. For now, oil drops as the U.S. and Iran hit pause on further strikes. We begin, though, with a massive week of earnings kicking off today. $24 trillion reporting over the next 5 days. Kate Moore of Citi weighed in on her expectations.
The thing that I love about equity so far in 2026 is that it's been earnings, not price, that has really kind of driven things. Like, look, everyone was concerned at the beginning of this year around multiples and around valuation. And this has been a recurrent concern. We continue to wring our hands as multiples have ground higher over the course of a number of years. But this year, because it's earnings and not multiples that are driving markets higher, and because the fundamentals continue to come in very strong, and we expect actually very solid reporting over the course of this week, that we feel more comfortable in continuing to add to positions.
Let's get the view from Kelly Covley, Senior Investment Analyst at Manning & Napier. Kelly, great to see you. How are you thinking about this week, not only the biggest of the entirety of the earnings season, but the big Mag 4 that we're going to be getting?
Yeah, I think all eyes are going to be on that Capex guidance number. We have had fantastic earnings growth year to date, sort of something you typically don't see outside of coming off of a recessionary period. But investors are starting to get a little bit concerned about that earnings quality with all this Capex eating into free cash flow. And I do think for the hyperscalers, there might be some risk that the market might poorly receive a higher Capex guidance like we saw with Alphabet. But I think potentially the bigger risk to the broad market would be if those Capex guidances come in on the conservative side. We've had so much of the market benefit from all this spending, such that when that turns, I think it could be painful, of course, for the memory and storage companies who in the second quarter had a phenomenal run, but also some of those industries that have benefited from the second and third order effects of that spending, like we have in utilities, some industrials, and real estate.
It's interesting just how much of this market feels correlated to a lot of the AI. But one of the more interesting trades I've been noticing, Kelly, it feels like kind of what you're talking about on days when the Mag 7, the hyperscalers are doing well, the check writers, the check receivers do poorly, the chip stocks fall, and vice versa. Chips are up, Mag 7 is down. That inverse correlation really seems to be building. What do you make of that? And is that a trend you expect to be continuing?
No, I don't think that's a particularly sustainable trend, right? If the hyperscalers really do respond to the market sort of tightening the leash on what they want those Capex numbers to be, I think the memory and storage companies, those chip makers could suffer, particularly those who have more commoditized products where, if demand falls, they also compete by cutting prices. So you have this sort of double hit to revenue.
It's tough out there. And I mean, you even point out we're in the dog days of the summer. Investors largely look past building risk. Kelly, what do you see as those building risks right now?
I think the oil situation is still an open question. This weekend, we did really get truly positive news with this pause. And we've seen that in these sort of lulls in tension, flows through the Strait can improve. But even in the best case scenario where you have a diplomatic off-ramp, which, again, at this point is a little bit unlikely or seems far away, you can't get things back online that quickly. It takes time to reopen pipelines and refineries and rebuild damaged infrastructure. So we think there could be a prolonged period of upward pressure on energy prices, just enough to keep the Federal Reserve sort of towards that hawkish stance that they previewed at the prior meeting. And for a long time, I think there wasn't too much concern about rate hikes because financial conditions were, and still to a large extent, loose. But we've started to see some signs at the margins that investors are starting to have a harder time digesting all that debt issuance that's coming out of the hyperscalers.
Then is the bigger risk for oil prices as they rise, Kelly, for this market? Is it just the follow-on impact for various industries like airlines, the hit to consumer sentiment, that sort of effect? Or is it the second order effect of higher interest rates? What do you think is the bigger risk that perhaps this market is overlooking?
I think there are two primary ones. One is just the volatility that businesses have to face in the course of their operations. We have the energy volatility and inflation volatility, and we also have some tariff uncertainty back in the headlines. The tariff rate as it stands now is not that much higher than it was before this most recent round of tariffs expired, but you might have some additional sectoral tariffs. You might have some differing levels for different countries. So that's something that makes business planning a little bit difficult. And it's the same story for energy. I will say for businesses, they are very used to having to adapt to this type of uncertainty. They did go from having to adapt to a pandemic, to rampant inflation, and then to unexpected tariffs. So they have proven their adaptability. But it makes things a little bit more difficult. And then I think what you mentioned about the second order effect on interest rates, I think that is the primary concern here. Again, it's just a matter of how much investors can take with so much debt coming on the market.
All right, Kelly, we're going to have to end it there. Thank you for joining us ahead of what's going to be a busy earnings season. Kelly Covley of Manning and Napier, thank you so much. A check on your markets this morning. We are looking at the S&P and the NASDAQ, both off of the highs that we've seen, up 0.4 for the S&P, the NASDAQ up just 0.1% again. The NASDAQ at one point pre-market was up more than 1%, so that starts to cool. The 10-year yield, that's down 2 basis points as Brent crude falls 6.6%. Let's get a look at some of the other movers on our radar. With that is Nora. Good morning, Nora.
Hey, Dani. First up, keeping an eye on shares of Apple, Amazon, Microsoft, and Meta. They're among the $24 trillion worth of S&P 500 companies reporting earnings this week. Sticking with tech, Nvidia is working on a fresh round of AI infrastructure deals, potentially worth more than $750 billion, including agreements with SK Hynix and OpenAI. Finally, airline and cruise stocks are rallying after the U.S. and Iran held off on attacks for a third straight night, sending oil prices lower. Shares of chip makers and other AI infrastructure stocks are also rising as easing geopolitical tensions spark a risk-on mood. Those are your morning movers. Dani?
Nora, thank you very much. Let's get the latest on the developments between the U.S. and Iran. Our other top story this morning, Bloomberg editor Wendy Benjaminson joins us from Washington. Wendy, it was a return to what seemed like calm over the weekend. What appeared to be the driving force between both the U.S. and Iran holding back on firing this weekend?
Well, Iran's the easy one because they said, well, as long as the U.S. isn't striking us, we won't strike any U.S.-related targets. The U.S. is a far more complicated question. They paused, and without a single word from the White House, the closest we got to an involved administration official explaining anything over the weekend was the ambassador to the United Nations, who we're not sure is, in the room for all the key meetings. We've seen reporting, both from Bloomberg and our colleagues, that suggests that the pause was due to advice from the top military commander overseeing the region that the U.S. is running low on anti-missile defense, on anti-missile defense weapons and equipment, and that there may be no more targets to bomb that are military. So you would have to go into a new and obviously more frightening stage. In other words, the targets have reached their effective level, and so why keep going? That's another possible reason. The other sort of unsettling thing, especially for oil markets, is that the president spent a good chunk of yesterday afternoon posting AI-generated images of U.S. warplanes just bombing Iran, bombing Iranian ships, bombing Iranian land, bombing Iranian buildings, always with Trump sort of in there, on the deck of the ship or, standing in the, as a pilot in a warplane. And yet he didn't actually say anything about the war either. This all comes against the backdrop of Benjamin Netanyahu, the Israeli prime minister, arriving tomorrow, who very much wants the war to continue until Iran no longer has a nuclear program. So we're just watching tea leaves at this point.
Again, that Benjamin Netanyahu coming to the U.S. certainly opens up an interesting dimension to this. I wonder how the relationship between the two have been going, because months earlier there was reporting that Netanyahu and Trump, that Trump had been angry with Netanyahu about the lack of progress and maybe him being dragged into this conflict that has not resolved itself as quickly as it seems. Where does it seem that we are between the two and their relationship?
Well, you know, it's a relationship that seems to change hour by hour. One of the reasons Netanyahu is coming to the United States is for the funeral of Senator Lindsey Graham, who died a couple of weeks ago, and is having he's lying in state at the Capitol, and then they'll have a service at the National Cathedral for him. So he's coming for that. But he also has a White House meeting in which he told Fox News yesterday that he wanted Trump to keep a constant watch, those are his words, over Iran's nuclear program. And in his view, the war cannot end until Iran has no longer any capability to pursue a nuclear weapon. That was the premise under which Netanyahu convinced Trump to start this war. But as you've seen in the last few weeks, not just over the weekend, Israel is no longer militarily involved in this war. And I do think the White House is irritated that they got dragged into this politically unpopular, politically dangerous war for Republicans, while Netanyahu is just sitting back there saying, go on, keep firing.
Right. Again, we'll see how that meeting and how that unfolds this week. Wendy, thank you so much for joining us. Bloomberg's Wendy Benjaminson. Coming up on the show, we're going to speak with Carlyle's head of asset-backed finance about why bonds have become a less reliable as an anchor. That conversation with Akhil Bansal coming up. This is Bloomberg Open Interest. Let's get you some high-interest stories, a look at what's making headlines around the world. Prime Minister Benjamin Netanyahu vowing to attend the UN General Assembly in New York despite a clash with Mayor Zohran Mamdani. Mamdani has called Netanyahu a war criminal, but backed off a pledge to enforce the International Criminal Court's warrant for his arrest after President Trump commented on the issue. LVMH CEO Bernard Arnault is finally on social media. The 77-year-old sent his first post on X in response to a series of newspaper articles suggesting his disunity in the family, including a 6-part series in Le Monde. Arnault said that that he is grateful for supportive messages that he has received following his open letter to Le Monde, in which he pushed back against the allegations. A heat dome descending across the central U.S. is driving up demand across regional power grids, affecting more than 100 people. Extreme heat and warnings and advisories cover the central U.S. from North Dakota, Canada border to South Dallas, with temperatures expected to feel as scorching as 112 Fahrenheit, hoping everyone stays safe and cool out there. Let's now turn to the bond market. Akhil Bansal, Carlyle head of asset-backed finance, examines why bonds have become less reliable as a shock absorber in a new paper, writing, quote, public fixed income is currently structured, struggles to simultaneously deliver income, diversification, stability, and capital preservation. The data suggests that what has worked for most of the past 40 years may no longer do so. So pleased to say that Akhil joins us now. Akhil, thanks so much for stopping by.
Thanks for having me.
And I have to say, I love in this paper that you say, look, I know just for integrity's sake, I am the head of ABF at Carlyle, so I need to be intellectually honest. So I like that you start with that. So it is maybe an uphill battle to, get everyone on board with what you're saying. But what has your research found about why traditional fixed income is no longer the ballast that it once was?
Yeah. So when we've looked at the research and thought about fixed income, what we have found is that when you look at some of the things that investors are really looking for fixed income and the role to play in its portfolio, that the data suggests that there's been a change. And I think in this new inflationary environment, what you're seeing is first that diversification benefit that fixed income is supposed to provide, that doesn't seem to be really playing out. For example, when you look at the correlation between public fixed income and equities, if you look at that 2010 to 2020 period, it was about 0.13. If you look at it from 2020 to today, it's closer to 0.63. That higher correlation, we think, is a structural change. And I think it's really explained by the inflationary environment we're in. Inflation negatively punishes both equities and public fixed income. And so I think what we talk about in the paper is how private ABF is not looking to replace fixed income, but play that role of generating that yield, that diversification that historically public fixed income has played.
And there's the chart of correlation there. You can see it has just spiked up, and it is just at 0.63 on the measure that we're using at the moment. I do wonder, okay, so it's this inflationary environment, but how much of it is also the huge amount of issuance coming from tech players that we have seen at this moment? The peak was in 2021. We've already issued 88% of that amount so far, and we're only just halfway past the year when it comes to tech bonds. Is part of it that, too, that this market is just being dominated by big tech players, much like the equity market is?
Yeah, absolutely. I mean, when you look at someone's IG corporate bond portfolio, what you'll find it's concentrated in the three same sectors that you'll find your S&P 500 portfolio is in. And even that's misleading because when you look at technology bucket, what you'll find is companies like Alphabet and Meta are actually categorized in your communications or your consumer cyclical bucket. So when you actually think about them being quasi-tech players and add them on, you find that you're much more concentrated into this AI and tech boom. And even the transactions that are coming out of that, whether it's the data center financings, the chip financings, if you look at the ultimate form of credit support, they're coming back to a very small group of corporates. And so I think the diversification is visible, but some of it may not even be that visible unless you really open up the hood.
So given these two trends, inflation, which is sticky, and the increasing issuance of tech players for this bond market, can traditional fixed income ever regain its portfolio position as something of a shock absorber? Or do you just think that that moment's gone, that we are in trends that are going to be difficult to break, and therefore this change is more permanent?
Yeah, I think when we think about traditional fixed income, it still has a home in the portfolio. Like it's liquid. It still delivers a level of yield. But if you're a institutional investor and many pensions who are looking for a actuarial 7 to 8% nominal return, you're looking for that non-correlation. What we suggest is that looking into the private asset-backed finance markets where you have ultimate drivers that are not correlated to corporate earnings, that's where you can find that yield, where you can find that diversification, where you can find that stability.
Right, and I know just last week, for example, we learned of a Carlyle deal on farm loans, for example. So that would feel incredibly uncorrelated. You talk, though, that bonds still have a place considering they're liquid. How do you treat the illiquidness of asset-backed finance and asset-backed credit? What sort of premium should investors be needing in order to accept the liquidity profile of the asset class?
Yeah, I think when you think about illiquidity premiums, it needs to be on the order of hundreds of basis points, we believe, in order to sufficiently compensate you for that illiquidity risk. I also think it's about the structures that you hold those investments in. And I think what we're very focused at Carlyle is being able to very clearly explain to our investors the type of liquidity they can expect and not expect when they come into these investments, because there is a trade-off there when you do come into these illiquid investments.
By the way, again, I mentioned the Carlyle deals that you're doing. They are incredibly diverse in different asset classes. How much of this industry, though, is maybe making the similar pitch, but doing asset-backed finance that still is within this AI ecosystem?
I think there is some of that going on, certainly. I think when you cut through some of the chip financings and some of the data center financings, ultimately what they're supported by are cash flows and leases ultimately to investment grade counterparts, and many of those being the hyperscalers. And so there is a element that you may be secured by an asset, but ultimately what supports that asset is a obligation or a cash flow from a investment grade corporate. I think when you look at Carlyle, some of the things we're doing is we don't look at AI monolithically.
Sure.
We think about diversification. So one of the areas we've been focused on is around energy and natural gas, because we think natural gas is going to become the next currency of AI. When you think about all the CGT power plants that are being built to power these data centers, well, they're going to need natural gas. And that's one of our power alleys is energy. So we have a venture with Diversified Energy where we've been going and acquiring mature, cash flowing, mostly natural gas wells, hedging them and securitizing them as a way to get that exposure and benefit from those tailwinds.
I mean, one of the pitches, and yours sounds very different from we've been hearing from some of your other big publicly traded peers, is that they are less asset managers now and just an AI company. This is a pitch that Blackstone, for example, has been making, saying we're a really cheap way to be playing AI, sort of trying to hint that they should be trading maybe at tech multiples instead of asset management multiples. Do you think that this industry does have a concentration problem itself, not even the traditional bond market, but for private capital? Do you think for many players that they are just getting concentrated too much on one specific theme of the AI ecosystem?
I think that when we think about portfolio construction, and like one of the things that sticks with me is something our head of credit says, which is diversification is the only free lunch. And when you think about diversification, you need to be able to peer through that when you look at a transaction structure and truly understand what is supporting my cash flows, what are the risks of those cash flows, and where is it coming from. And I think when we take that approach, what we find is there's many areas beyond AI that you can still earn very attractive returns. You can benefit from what's going on from a macro perspective without having a monolithic view of saying, I am singularly one thing.
Right. Akhil, thank you so much for bringing this paper. Highly recommend everyone giving it a read. It's really fascinating. Akhil Bansal of Carlyle. Still ahead, H.B. Fuller President and CEO Celeste Mastin joins to discuss her company's M&A outlook. This is Bloomberg Open Interest. A check on your markets nearly an hour into your trading day. The NASDAQ now falls down 0.2% at the lows of the morning as we gear up for big tech earnings. 10-year yields, those are still declining, down by 2 basis points. Brent crude down below $91 a barrel. It does seem to be some of the pressure coming from China and cheaper offering of various chip-making equipment weighing on the chip makers this morning. Coming up, H.B. Fuller CEO Celeste Mastin joins to discuss her company's future. This is Bloomberg Open Interest. When H.B. Fuller announced its acquisition of Advanced Medical Solutions last month, the deal quickly drew pushback from activist and banker Ankara, even before the deal was closed, which argued that the company should focus on paying down debt instead of pursuing another acquisition. H.B. Fuller, though, says that the deal is exactly the strategy it laid out for investors. Here's what both sides told Bloomberg.
I think our opposition to this is largely based on the fact of that some of the issues we raised in our letter yesterday. But the first and foremost is the company just in March had said publicly that their plan was to pause all M&A, closing all M&A deals, and focus on deleveraging the balance sheet.
We're doing exactly what we said we would do. We're growing in our medical adhesive space. And this is something we promised our investors during our investor day last October, and we've been speaking to this direction for years now.
You heard from her right there. Let's bring her back. It is H.B. Fuller President and CEO Celeste Mastin. Celeste, thank you so much for joining. Great to see you.
Thanks for having me, Dani.
So you've had a month or so under your belt since this was announced, not causing a little bit of drama maybe along the way. How have conversations been since you announced this?
Yeah, we continue to execute on our strategic plan, Dani. So we are definitely having conversations with investors. We're always interested in what they have to say, their suggestions. But as we consider the opportunities before us, that strategic plan is where we believe we can drive the best value for shareholders. And you've seen, we've been very transparent about being in the medical adhesive space. And actually, over the course of our execution of this plan, we've been able to increase our EBITDA margins by approximately 400 basis points since we started. So we're going to stick with it.
I'm always so interested about how you handle an activist investor, especially when their ability to launch a proxy fight. They have to wait till the next season, which is in April. So their ability in court to even do anything is kind of limited besides making noise. How do you approach that, whether it's them or any future activists? Is it you work with them, or is it, look, you put this to the side and convince the wider shareholder base we're doing the right thing?
Yeah, we are very interested in listening to all of these shareholders, and they don't always have the same perspective. All of them have insight to share. Certainly, it's in our best interest to ensure that we're taking all of that feedback in and then determining what we think the best path forward is for the company. And we think the best path forward in this case is acquiring AMS.
So in a little over 2 weeks, UK shareholders get to vote on this deal. What sort of feedback have you been hearing from them? Are you confident that it'll pass on their end?
Well, we're not able to speak with the investor base about this, particularly the AMS investor base. But I do believe they're going to see that the combination of these businesses is so strong together and that they are going to vote in favor of the deal.
So in terms of where the kind of tension laid with Ankara, it was about this idea that you said you'd pause new deals. But you've been saying, look, we promised our investors that we'd go down this strategy. It's not necessarily about M&A. How are you thinking more broadly then about M&A? Is this very much so a one-off because it fits that strategy bucket, or would you be interested in pursuing deals further?
Yeah, so the way we look at our M&A strategy is fundamentally looking at the strategy for the overall business. Every year we bring in our 32 global market segment leaders. They pitch a growth strategy to us, and then we determine where are the top 20 opportunities that we need to invest in as a company to continue to move the portfolio to the highest margin, fastest growing spaces in this $80 billion industry. So when we identify those opportunities, we then determine, do we buy or build? And most of the time, because this is such a fragmented industry and because we have so much scale as the largest pure play adhesive company in the world and have synergies, it makes sense to buy. And so we're going to continue to look at those opportunities, and deals are an important part of our strategy. Now, that said, we will have some delevering to do after we acquire AMS. So deleveraging will be first and foremost priority.
So maybe deals in the further out future, but not in the immediate future.
That's correct.
So this one's interesting because when it comes to adhesives, medical adhesives obviously are very acyclical. There's always going to be demand for that. What are you seeing in the other core parts of the business? How does demand look right now, and what kind of view of the economy is that giving you?
Yeah, so as you know, we're a very global company. So we have a good perspective on the global market, particularly the global industrial market. You know, we've been very successful in our engineered adhesives business, although I would say those durable goods are under pressure globally. Our building adhesive solutions business is really strong, posted a really strong Q2, 6% organic growth, so much better than I would say the overall construction industry is operating today. And then our HHC business is that base load business of ours that we rely on globally to pay a lot of the bills.
It's been a lot of shocks that this economy has had to deal with, which I'm sure has been an interesting time for you. One of the ones that we've had since the first Trump administration, but again in the second, is more tariffs. And it's an administration that saw Section 122 tariffs expire on Friday. So they pushed through new ones, either 10% or 12.5%. UK gets 10%, and I know AMS is a UK business. How have they impacted you, and what sort of workarounds have you found?
Yeah, so you know, 99% of what we sell in the U.S., we make in the U.S. So that's very helpful to our cause. Now, however, we, of course, do get raw materials from all over the world. So we import a lot of raw materials. And while we are very nimble and we've been able to shift our supply chain in a lot of situations, we do still face higher raw material costs, which we've been passing through to our customers. So you know, it is a challenging time, but ultimately, in a period like this where we've got tariffs, we've got the conflict in the Middle East, our first and foremost priority is to be a reliable supplier to our customers. We're always there and we're always delivering.
Yeah, I remember you spoke with Romain and Katie about this last month, about your ability to raise prices and your customers are able to meet you there. The war in the Middle East, that's an interesting aspect because we have seen things like petrochemicals, for example, be held up in the Strait of Hormuz. Has that been a bigger impact than tariffs, or are tariffs still the biggest impact?
The Strait of Hormuz has been a bigger impact. Absolutely. The global petrochemical supply and demand environment is shifting rapidly. We have been able to quickly moderate the impacts of that, shifting raw material purchases from one region to another. So we've been able to reliably serve customers, and you can really see that the organic growth that we posted in Q2 in Europe and in Asia, both high single digit. And again, that's because we've been able to be a supplier that is reliable and can source raw materials despite all of the chaos in the world.
I mean, you as a business leader have had to deal with a lot and have had to change different tactics, be it with petrochemicals or with tariffs. Coming out of all of this, does it give you more confidence to handle more disruption? Because one of the amazing things of both the American economy and really global economy has been business leaders like yourself able to adapt. Do you think something has sort of changed in how you see the business and your ability to navigate more headwinds as they might come?
I think that's the case. I think that we have become even more nimble. I mean, I have an amazing team of people, both my management team and committed employees down through the ranks that are doing everything they can to serve the customers well. And I do think that we have learned how to adjust really rapidly to these changing circumstances.
Well, it's pretty great. Even when AI takes over, you still need adhesives. So that's a great thing.
Absolutely. Absolutely.
It might come from my job, but not yours, Celeste. Thank you so much for joining. Really appreciate your time this morning. Thank you for stopping by, H.B. Fuller President and CEO Celeste Mastin. Let's get a check on your equity markets this morning. About an hour and 10 minutes into your trading day, and we are moving lower this morning. We started the day with gains. Now we're down 0.8% for the NASDAQ. So at the low for that, and the S&P turning negative, being dragged down by chip makers with some threats coming from China and their ability to produce cheap chips and chip-making machines. Brent crude, that falls now below $91 a barrel. Let's take a look at some of the other single-name movers on our radar this morning. With that is Nora. Hey, Nora.
Hey, Dani. First up, AT&T opening books on a euro and sterling bond offering for at least $2.2 billion. The company also expanding its computing deal with D-Wave Quantum. Elsewhere, Jack Daniel's owner Brown-Forman rejecting a renewed $15 billion takeover offer from Sazerac, saying it, quote, does not align with the company's vision for the future. And lastly, Philip Morris announcing that it's doubling investment in its Colorado Zinn manufacturing plant to shore up supply. Those are your morning movers. Dani?
Nora, thank you so much. Coming up, China's largest IPO in more than a decade surges in its trading debut. We're going to look at that blockbuster offering, plus the rest of the China chip space threatening this American market. All that to come. This is Bloomberg Open Interest.
We used to build computers for people to use, and we're going to still continue to build incredible computers. These are now processing AIs for humans to collaborate with. But in the future, we also have AI agents and robots, and they're going to be using computers. So instead of just a billion people using computers, we're going to have 100 billion agents and billions of robots all using computers. The computer industry, the chip that's built on top of the chip industry, surely is not big enough.
Nvidia CEO Jensen Huang speaking with Bloomberg Tech's Ed Ludlow in an exclusive interview. His comments come ahead of another critical week for AI as big tech earnings roll in. We'll get Microsoft and Meta on Wednesday. Apple and Amazon come later in the week as well. Joining us with more is Bloomberg Tech editor Sarah Fryer. And even to set up this week, because they couldn't be, content just waiting for earnings to make noise, Nvidia inks a $500 billion partnership with SK Hynix, $250 billion with OpenAI to help lease and finance a data center. Again, sir, it's these concerns about circular financing. Why is Nvidia spending so much still in companies that are quite often their customers?
Well, it's really hard to get that level of financing from anyone. And we've seen it, too, from Google, from Amazon funding Anthropic. There's a lot of activity right now where the established players and the players that are selling the cloud computing or selling the chips are giving their cash to or backstopping deals for these companies that are that are really not upstarts anymore. Like, these are big companies. There's pressure on them now to show profitability from the models that they've built, from the tools they've built on top of those models. They have IPOs ahead. So really, they're in this position where they're trying to show that they are established businesses that can be sustainable. At the same time, they still need so much cash to continue out this infrastructure build that is incredibly capital intensive at a time of increasing prices for materials.
And it's capital intensive. They're spending more. When there is this nation threat coming from China and their ability to produce cheaper chips with the IPO we saw this morning skyrocketing, not even just the chips, but the chip making equipment, a new company, a state-backed Chinese one, is smashing ASML in the Dutch trade. And then there's the open source LLMs too. I mean, Sarah, in this ecosystem, just how under threat are American companies from what China is producing at a cheaper rate?
It's a huge concern. You know, there was that letter also on Friday from major leaders in tech, including Satya Nadella, including Jensen Huang, saying that they really are supportive of open models, given that China seems to be ahead on that front. I mean, the majority of models that U.S. companies are using right now, if you look at it by token, which is the calls to the AI, are these Chinese models, not the U.S. ones. So in order to be ahead of China, you know, we really have to think about all the implications there. That said, we want, you know, these businesses, OpenAI and Anthropic, to make money off of the models that they're building. So there are all of these push and pulls. You know, what are we going towards here? Like, we want sustainable businesses. We want open models to compete with China. We want a chip making industry that will you know, profit off of this, but not get too tied up in the risk, right? There's so many factors at play here. Looking into big tech earnings, we're really going to take a look at the amount of risk they've taken on, the capital expenditures that they plan, which is going to have very large implications for the chip industry that supplies, but also for the sustainability of their business models.
It's true. Does it seem like we're still in the environment, the Satya Nadella, of the bigger threat for them is not spending enough versus spending too much? That they're still on all out, our CapExes are going to be huge, and forget you market that sells off when we announce it, we're still going all out.
And to some investors, that level of certainty and belief is encouraging. Like, they do see that this market there's still so much growth left. If you look at the cloud backlog for Google, you know, it's still so tremendous. They're not able to service the amount of demand that they currently have for their products. So they're saying we need to build out. We need to build out now. But, you know, meanwhile, the materials are getting more expensive. It's not clear that there's going to be a return on investment. Ultimately, consumers are going to want to pay the amount of money, like, they're going to have to want to pay the amount of money that will pay back all of these investments. So over time, we're looking for this much efficiency, this much revenue to come from people who want to use these products, right?
Sarah, it is so great to have you in New York. I have a feeling we're going to catch up later this week after all of those big tech earnings. Thank you so much for joining. That's Bloomberg's Sarah Fryer. Coming up on the show, we're going to be speaking with Kalshi's chief risk officer about the company's push to expand perpetual futures into metals. That's coming up next. You're watching Bloomberg Open Interest. It's time now for our metal spotlight. Kalshi is looking to bring perpetual futures beyond crypto. The company seeking approval to launch contracts tied to gold, silver, platinum, and says copper could be next as demand tied to AI and computing continues to grow. Joining us now is Kalshi Chief Risk Officer Udesh Jha. Udesh, thank you so much for joining this. And look, these perpetual futures are something you traditionally see, for example, processing tens of billions in crypto. Why expand this out into hard commodities, into precious commodities?
Thank you for having me here. I think it's a great question. I think we have already seen the innovation that perpetuals have brought onshore with the launch of our crypto perpetuals. And we have started to see a lot of crypto or perpetuals grow on real world assets like metals, like S&P, like crude oil offshore. And what we are trying to do is build an ecosystem so that they can be offered in a regulated platform like Kalshi.
Who is your audience here? Is it those who already trade on Kalshi, maybe are more used to trading crypto? Or are you trying to tap that retail investor who's maybe in ETFs now, or maybe trying to deal with rollover headache costs of futures themselves? Are you trying to gain market share in this overall industry?
I think we look at ourselves at servicing both retail as well as institutions. If you look at gold or silver, they are products that are used by retail as well as institutions. They are a store of value. And perpetuals provide for a continuous exposure. They don't have any expiry, which means that you don't have to pay the roll costs. They concentrate liquidity in one contract. So there are many benefits that both retail as well as institutions can have with these perpetual contracts.
Well, I know with the crypto perpetual contracts, they trade 24/7, and as does crypto, and that's one of the appealing things for this. For now, you're just matching the underlying market, which trades 24/5, so only 5 days a week. Could that change, Udesh?
Yes, we wanted to start off with basically matching it to the underlying markets. There's a lot of things happening in the financial sector today. There are many other markets that are moving from weekdays to weekend trading, or potentially move from daytime trading to 23/5. Our thought process was that we want to start with a 23/5 or 24/5 market, and then see how it goes. I think eventually we have seen the power of both perpetuals as well as prediction markets to provide for a lot of price discovery over the weekends. And as the market grows in the underlying sectors, whether it's futures or traditional futures or cash, we will surely look at expanding it to 24/7.
It's a market that we've seen a lot of pushback from your entrants and others. Traditional exchanges like CME have really started to push back on prediction platforms trying to expand into what they see as their territory, but more traditional type futures. Udesh, how do you see that pushback, and does that translate at all to things like CFTC pushback? Is it harder to pass regulators when you are encroaching right on the doorsteps of more traditional exchanges?
Well, our thought process is that we are not necessarily going for the market that looks at dated contracts with these products. We are not looking for those constituents who like specific expiries in the future, because that's not what perpetuals offer you. Perpetuals offer better pricing. If you look at a price of a perpetual on any, whether it's a crypto or any other asset class, compare it to the cash market or the spot market price, you will see that they track much closer because of things like funding adjustment and so on and so forth. They also provide, because of good price matching, they provide for better risk management. And in addition, because there are no rolls, they are much more cost effective. So when you make these innovations, obviously there are incumbents who will look at it, because there is a lot of fees associated with the rolls and others that may potentially be impacted. So, but our view is to provide better risk management at a better cost, and so necessarily we don't think ourselves competing against the traditional products, which will have a demand as well. There are a lot of use cases, like a agriculture company hedging a future date, or an airline company hedging a future cost of oil. But we are not competing, or we are not providing that marketplace at this point in time. We're looking at purely folks who want continuous exposure at a better price and improved risk management.
Udesh, how do you respond to the broad criticism, which I'm sure you hear lobbed at Kalshi a lot, and not just you, your competitors too, that it's the casinofication of everything, that you're essentially allowing for more risk, and more risk specifically along the lines of retail investors that they perhaps wouldn't have already taken? And apologies to rush you here, I got about a minute left.
No, I'm glad that you asked this question, because the perpetuals we offer, we should actually have a different name for it. We should call it regulated perpetuals. What we are offering, we are not innovating in risk management. Whatever we are offering perpetuals onshore follow the exact same routine as a traditional futures that trades. Traditional futures have a lot of leverage. If you look at some of the traditional futures like S&P futures, they have 15x leverage. Gold has 20x leverage. Some of our crypto perpetuals, they only have 6 to 8 times leverage. We also do not do things like auto liquidation through the clearing house, which is something very consistent with how a traditional futures manages risk. So there are many things, and I think we need to distinguish between a regulated perpetual and what trades offshore for a better answer.
Udesh, thank you so much for joining. Really appreciate your time this morning. Kalshi Chief Risk Officer, Udesh Jha.